Hello and welcome to Macro Pulse. Last week, the US Court of International Trade declared some of Trump's trade tariffs as being unlawful. They in particular referred to those tariffs that's been put in place on the 2nd of April, which is the base 10% unilateral tariff on global countries, as well as the reciprocal tariffs and those additional tariffs that Trump has put on China. The court judged that Trump, as the president, doesn't have unilateral power to impose these tariffs on all countries, and that only US Congress, according to the US Constitution, does have the power to regulate international trade that cannot be superseded by the president. Also, these tariffs has mainly been used as a negotiation tool and not for national security purposes. So the court judged that the Trump administration has to halt its taking of revenue from these tariffs within 10 days. The Trump administration appealed this, and the decision was taken by the appeals court to keep these tariffs in place until the Supreme Court have made their judgment. At the moment, we don't know when the Supreme Court will make their judgment, and therefore it can take weeks or months. So nothing really has changed from a tariff perspective, and is unlikely to change in the near future. If the courts do decide to make Trump's tariffs unlawful, the tariffs that he has announced thus far all falls under the International Emergency Economic Powers Act. And outside of that act, he has got several other alternatives, other acts that he can use to impose tariffs. For instance, Act 122 or Act 232, 301 or 338. These are all acts that he can utilize to impose tariffs on the basis of discrimination, unfair practices, or because of national security. So the Trump tariffs are not going away. In fact, the trade relationship and the tariff uncertainty will continue to linger for a while more, because Trump has recently threatened to put the 50% or the 25% steel tariff up to 50%, and the relationship between the US and China has also soured on the back of the trade truce that was set in Geneva, and the US accusing China of not adhering to that agreement. The trade deal between Europe and the US is also ongoing, and in our mind, unlikely to be set very quickly, because Europe consists out of so many countries with so many different objectives. We're also likely to see the 90-day pause that was imposed by Trump in the early part of April to expire on the 9th of July. Then we'll have to see what Trump will do with those reciprocal tariffs at that stage. So for now, I think the Fed is right in saying that they're in a wait-and-see mode. The implication of these tariffs is still that inflation can rise and that growth can slow down, and therefore the Fed's reaction function remains uncertain to the market. The market itself is also still looking through the economic data. As we've seen more recently, soft data, the survey data, has improved slightly from very depressed levels. At the same time, you see the hard economic data starting to weaken as the impact of these tariffs are starting to flow through the economy. So recently we saw that the first quarter GDP number in the US, the first revision, showed that the household consumption component was actually weaker than initially anticipated. We also see that housing activity is weakening. So pending home sales, for instance, remains very weak, and that's a very good leading indicator for housing activity. We also saw that the savings rate in the US under consumers have ticked up slightly as the consumer become a little bit more cautious. Turning to South Africa, we had the first quarter GDP number out this week, and overall the print came out slightly better than the market expected. It showed that for the first quarter of 2025, GDP grew at 0.1%, while the market was expecting a negative print of 0.1%. However, when we compare that with Q4, where we saw growth of 0.4%, it still implies a slowing of the economy. And looking at the different components, on the demand side, you had household consumption coming in positively, but it did show some slowdown. And on the fixed investment front, we saw that contraction has deepened further. If you look at the supply side, agriculture was the big surprise factor. It grew by about 16% quarter over quarter, and which is another strong print after also a very robust and strong print in Q4 last year. But if you look at mining, construction and manufacturing, all of these sectors have and remain within contraction. So with 2024 GDP now out at 0.5%, very weak and soft growth number, and the growth outlook for 2025 also quite soft, it was a very welcome surprise to see the SARB cut rates by 25 basis points. The surprise wasn't really the cut, the market expected the cut, but what the surprise was that in the vote, you had a split of 5-1. The market expected initially that you will get 5 members in the MPC voting for a 25 basis points cut, and maybe 1 or 2 voting for it to be rates to be on hold. What we did get was 5 voting for a 25 basis point cut and 1 member voting for a 50 basis point cut. So that was a dovish surprise to the market. We also saw that inflation was revised down for 2025 from 3.6% to 3.2%, and the growth number was revised down from 1.7% to 1.2%. So both of these are fairly dovish revisions. The SARB's own forecasting model also showed that there will be another cut potentially later this year. In our view, we believe that the next cut will be at the next meeting on the 31st of July, and then the SARB will be in a wait-and-see mode to see what happens to the US. Will US growth slow? Which may mean, if it does, that if the Fed cut, that the SARB may ultimately cut by more as well. And will we get an announcement around the inflation target? So at the SARB meeting last week, the SARB reiterated that both National Treasury and themselves feel that the inflation target is simply too high relative to our peers, and which makes us uncompetitive. And that the ultimate aim is to bring the inflation target to the lower end of the current target band, which sits between 3 and 6%. The question is, how are we going to get there and how quickly? Now, according to the SARB's own projection models, they've started to look at a 3% scenario, and they believe that they could ultimately stabilize inflation at about 3% within the next 18 months to 24 months. And even within that environment, they believe if inflation expectations fall sufficiently fast, which according to them it will, they can cut rates further to below 6% within the next few years. So structurally, we could potentially see lower policy rates if indeed we get inflation expectations being successfully grounded to around 3%. Now, with inflation at the moment at 3%, we are now provided with a window of opportunity to change the inflation target to, say, 3%. Well, at the moment, the target hasn't officially been changed yet. There's still discussions between National Treasury and SARB. There will be some recommendations, but we believe we will likely get an official announcement within the next 2 quarters, potentially by or before the medium-term budget. Local bonds have continued to hold their positive momentum, as you know, a cut to the inflation target ultimately means lower borrowing costs. It potentially means an improved fiscal scenario. The SARB have in their paper estimated that they could save up to 900 billion rands in debt servicing costs over the next 10 years, if indeed we are successful in implementing a lower inflation target. Bond yields have fallen over the last 2 months by almost 100 basis points. And so, we like to prefer and favor local assets. Over the last year, SA bonds have delivered 20%, SA equity about 26%, and the rand has appreciated about 6%. And that's less of a surprise if you do consider that the GNU this month is a year old. After all the volatility that we've seen over the last year, we have delivered a budget. The budget shows that fiscal consolidation is still a priority. We've seen that the US-SA relationship have improved slightly, and that there's scope for to build on this for further improvement. We've also seen that the gold price have risen, the oil price is down, which means that the terms of trade have improved in the country. And so all these positives, together with still slow economic reforms that's taking place, provide, at least on a relative basis, an attractive proposition to investors. So in our view, if we have to look at global markets, we prefer South Africa and emerging market assets as a defensive play relative to the developed market assets that often gets dragged down by worries about Trump, trade, tariffs, and the tax cuts. Thank you for watching.